Hello and welcome. You're watching Market Wrap, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, ICICIdirect. Welcome, Pankaj.
Hi, good evening, Ritu.
Very good evening, Pankaj. Positive bias still intact in the market, but any uptick that we're seeing in the market right now is being sold off. So Nifty now slipping below 18,500. Are you still positive on markets? And with major events like RBI now behind us, oil below 80, what will be the next big trigger for the markets from here?
So yes, after hitting new lifetime highs of 18,900, we are seeing markets or Nifty sort of consolidating in this broader range of 18,400 to 18,900, and which is what we were also sort of looking at. And our sense is that overall, while RBI policy is behind us, but I think the bigger anxiety is obviously from the US Fed, which is where we could see action next week. So we have both
Okay.
inflation data as well as the US Fed policy next week. But our overall sense is that the inflation trajectory domestically or even in US is slightly lower. So that way, we would expect markets to sort of rally from here on and rally to levels like say 19,400. Even
Okay.
historically, we have seen that for the period of say mid-December to mid of January to end of January, last 7, 8 odd years, things or Nifty has been very positive with an average gain of 7%. And that's not only true for Nifty, but even for mid caps also. So our sense is that overall, from next week onwards, we would see this uptrend resuming, and Nifty will head towards 19,400 kind of a levels, with a
Okay.
broader outperformance or a bigger outperformance coming from mid caps and small caps.
So if we talk about the mid cap space, Pankaj, which are the stocks that you like in this space?
So I think a lot of names. So right from say a lot of road infrastructure players, be it KEC International, be it PNC Infra, KNR Constructions. Then I think a lot of troubled names where say something like Supreme Industries, the pipe or the PVC prices had sort of has been very volatile, and as a result of that, the margins for a lot of these companies operating in this sector has been sort of quite volatile. And in addition to that, the mid-cap cement as a overall space looks attractive to us. I think next 1 month or going forward, infra as a overall theme looks very attractive to us. I think that is one space where we can see a better move compared to a lot of sectors. We have already seen that move panning out.
If we talk about the RBI policy, Pankaj, this time we had a 35 bips hike in repo rate, but at the same time, the GDP forecast has been cut. Are you worried about the same?
Absolutely not. I think RBI is sort of quite cautious, and which is why when you sort of look at their crude oil assumptions, they've taken $100. I think they are sort of cautious from the perspective that globally a lot of uncertainty still prevails. I think even with 35 bips hike, we haven't seen that kind of a material movement in yields, which is what probably implying that while RBI is keeping the door open for a further hike, but market is
Right.
not expecting any further rate hike to happen. And I think on the GDP numbers, since there is obviously a global slowdown anticipated, so which is why the GDP growth rate for this year has been cut to 6.8 odd percent. And so I don't see anything alarming except for the fact that we still don't know how global macros or global major global economies will do in terms of growth, and which is why RBI is also sort of cautious from that perspective. And for banks, I think overall rate hike of this will pan out in the next 2 or 3 quarters, and which is going to obviously keep their NIMs or spread at elevated levels. And I think credit growth, despite all that, RBI has maintained a pretty healthy credit growth of 14 odd percent for this year. So that way, I think nothing alarming. Its policy on usual lines.
Pankaj, this week again, it was the PSU banking space which outperformed, clearly outperformance. And it has been a continued run for all these PSU banks, you name it. I mean, today we had the Bank of India, Bank of Baroda, Canara Bank. How much more steam is left?
Well, yes, when you sort of look at PSU banks, the PSU bank index itself is up 70%. I mean, when you sort of compare with Nifty, that's only up 5%. So obviously, there is a possibility of further re-rating in PSU banks, largely driven by the lower valuations what you have seen. And I think good part is that most of your PSU banks are expecting good loan growth. So there is an improvement in margins, credit cost is lower, and our sense is that they will also continue to experience a margin expansion because of the rate hike, because deposit repricing happens with a lag. And I think on top of it, there are some structural changes which the government has also announced. So if there is a continuity of leadership for a longer period of time, one, obviously, it improves the accountability. The other is that banks can implement long-term strategies. But having said that, you have a long list of PSU banks which have been sort of doing well, but our only sense is that it is preferred to, or we would prefer to stick with, say, tier one names. So, which is why we continue to like SBI, State Bank of India, or Bank of Baroda, or Indian Bank, because I think one also needs to be cautious from the perspective that in case of a down cycle, a lot of these banks perform poorly in across major parameters, and which is why cautiousness needs to be maintained. So from that perspective, I think overall we are positive on three banks. We would expect, say, ROAs of SBI to sort of improve to 1%, whereas for Bob, while the management is guiding to 1%, we are expecting about zero point 0.8 for FY24, and same is the case with Indian Bank. So obviously there is a scope for further re-rating of these banks, but I think one needs to be choosy and one should not really downgrade too much in terms of quality of banks.
It won't be fair if I don't talk about Yes Bank, Pankaj. What a move that we saw on Yes Bank this week. So, what should one do?
So I think largely when you sort of look at banks, you have a lot more smaller tier two private banks which are looking good. Say for example, Federal Bank or IDFC First Bank or City Union Bank. I think Yes Bank is moving on the basis of news that you will see new investors coming in. But I think the balance sheet is already sort of bloated. It is going to take a lot more time for them, for their ROEs to come into double digits. And which is why we are not chasing or we are not recommending, while yes, we are getting that price performance, but we are also conscious of the fact that you need to sort of not only recommend from upcycle perspective, but you also need to keep down cycle also in perspective. And risk mitigation is, I think, the biggest important factor to sort of look at, and which is where I think historically, Yes Bank does not have a very great track record.
Let's now talk about the infra space. The government spending has been quite buoyant in the first half of FY23, and it is expected that second half would be equally good as far as the spending from the government is concerned. So, what is your take on the infra space, and which are the stocks that you like the most?
So yes, infra as a space looks very attractive to us. I think post Gujarat elections, I think what is clear is that the government will continue to sort of have higher focus on infrastructure, which has been the case in the last 5 6 years. In fact, if you look at last 5 years, the infra or government capex spend has grown at about 23 odd percent. So last year, that was 7.5 lakh crores. We would expect those numbers to be upwards of 9 lakh crores. And when you sort of look at sub-segment wise, road, railways, and defense, I mean, typically they contribute the two-thirds of this entire overall spending. And which is why I think it is important to focus on these three segments. Now, when I come to the overall infra as a space, I think companies what will get preferred is say something like L&T. So it has got the highest order book of say 3.7 lakh crores. And last quarter order inflow was also pretty good. So I think this is one company, a big company in the overall EPC space, which will be the beneficiary of the entire positive rub off of CapEx. They're guiding for mid-teen kind of a growth, both top line on it. So which is why it's a sort of a portfolio stock. The other I would recommend is a Thermax. Now, heating, cooling demand, especially in the case of energy and environment, is on the rise. And this company has one of the best metrics, so they would never chase orders at the cost of margins. So which is why they've got the best balance sheet. And our sense is that they will sort of do well in this upcycle. So which is why we would expect this company's revenue to sort of grow in high teens and bottom line by about 25%. The other is KEC International, since there is a lot of focus on the railways also. So this company is a major infrastructure player in the power T&D space, and railway is another focus for them because they is their business model. So I think this company also has been witnessing margin pressure. We would expect margins to sort of improve from mid-single digit to high single digit, and that should sort of drive a decent amount of bottom line growth at 53 odd percent and valued at decently at about 17 times. And then in a smaller space, we would prefer, say, PSP projects. I mean, this is one company which has done good work in Gujarat. Now they can bid for higher projects of 2,500 crores. And which is why I feel that they can also grow their revenues by 15 odd percent. So here the target price is 720.
Okay. Coming on to the cement space, we are seeing, cement companies now resorting to increase in price. Some of the regions has already experienced it. So, what is your take on the cement space? The kind of momentum that we are getting in these stocks right now, is it sustainable? And what is the reason that you would be positive on cement space now?
No, so when you sort of look at till last quarter, things were very bad for cement as a overall space. But what we have seen is that post monsoon, the construction activities has sort of picked up. There is obviously a higher anticipation of higher capex allocation, which obviously cement as a sector will be beneficiary of. And what has also happened is that we are seeing fuel costs sort of declining by 250 to 300 rupees per ton. And also they have taken a price hike. So cumulative effect of that is that we would expect their EBITDA per ton to sort of reach to 1200, 1300 by Q4. And I think we are also expecting consolidation in the industry because you have players like Ambuja ICC, which are quite aggressive. Now, coming to what one can sort of look at, one obviously approach is to look at tier one names like, say, Ultratech, where our target price is 7,700, or JK Cement. So these are companies which have announced a pretty aggressive capacity expansion plan over the next 3-4 years. The other approach is to sort of look at companies which are trading below replacement cost. There you have the likes of JK Lakshmi Cement or Orient Cement. So JK Lakshmi Cement, even with the run up, I think they're still trading at about $88, $98 per ton. The replacement cost is between 100 and to 130. Something like Orient Cement is $45. And then one can also sort of think if the risk appetite is more in terms of M&A possibility candidates. So you have Heidelberg there, or you have Sanghi Industry, which is sitting on huge amount of debt, or Nuvo Coco, which is a new player but still struggling. So I think overall space, this looks good given the fact that one, macros are turning positive, and I think cost-wise also things are looking good for most of the cement companies.
Pankaj, what is your take on the IT space? We had a Credit Suisse report. Maybe today only we had that report, which stated that if U.S. economy worsens from the current state, we might see another 15 to 20% downside for Indian, frontline IT stocks. Does that hold true?
So I think we have seen a decent amount of crack in IT stocks on Friday, largely because HCL Tech has an analyst day in New York, and there they have hinted that the overall guidance. HCL Tech earlier had given a guidance of 12 to 14 odd percent overall growth, and which they subsequently revised to 13.5 to 14.5% kind of a growth. But now they're hinting that probably they would be able to achieve only the lower end of that growth. But I think a lot of things are still not clear because IT as a segment they've been quite bullish on, which is contributing about 76% of their business, and then you have ER&D and other businesses. So I think obviously, but concerns are there because now if a company is saying that they are higher than normal furloughs, and then there's some concern in some sectors like high tech, telecom, and even the pricing is also selective, so they are not getting price hikes across. So that way, yes, there is a near-term concern, but I think we also need to watch out for whether other companies also declare something of that sort. But having said that, I think a lot of pain is already there in the prices. While the quantum of recession is still not known in US, but yes, it is a fairly anticipated phenomena, and which is why we are not expecting IT stocks to sort of perform or outperform in a shorter duration. But yes, our sense is that in the next 4 to 6 months down the line, you will be clear in terms of what quantum of decline you would see in US GDP, the kind of recession, and the kind of, and I think pricing decline has already happened. So post that, if there is a reversal in terms of Fed stance or number of other factors turn positive, our sense is that IT will be the first as a sector to sort of recoup. So it's, yes, challenging times for IT at the moment as of now.
Crude oil prices below $80 per barrel. What does it mean for companies like HPCL, BPCL, IOC, and for Reliance Industries and ONGC?
So one is, I think, one implication obviously is that you'll not see windfall tax sort of continuing for long. I think which is what is largely hinted also by the government. Now, when you sort of look at while the crude oil prices are down, so it is a clear pointing towards that while the China is still sort of opening up, people are not comfortable whether the other parts of the geography, be it US, Europe, whether they'll be able to grow. So, which is why there is a softness in crude. Now, having said that, this is a positive news for your downstream companies because while the refining margins were picking up, they were okay. They were making losses on the marketing side. I think that is where it is going to help them a lot, and which is why I think it's a sort of a short-term positive for some of these companies. But having said that, you can't expect a meaningful or a structural run in most of these names. I mean, be it upstream companies or be it downstream companies. At best, it can be a sort of a technical buy. Beyond that, we don't still think that these stocks become portfolio stocks. So nothing changes structurally in most of these companies.
What is your take on Paytm? Because now the company board is mulling buyback. It might be to really, stop the stock price from falling further. What is your view on that?
So usually new age companies we have not been tracking largely because we still don't know what is the path to profitability, and then on top of it the valuations have been rich. I think so, which is we've been sort of avoiding, and most of these companies we are still not sure whether they are sort of catering to a white space. I think except for something like Zomato, which is into a segment where we feel that is a white space, and they have the pricing power to sort of where they can sort of increase the prices without much of a fuss. So I think
Right.
so. I think that probably looks structurally more positive. But having said that, we don't have a coverage on most of these names, and which is why I don't carry a view, and neither we don't intend to sort of cover these companies anytime soon. So I think we would want to sort of wait it out for some more period of time, let them sort of deliver sustained profits for some quarters. Then only I think probably we might cover, and I'll be able to give a view.
Sure. Let's now talk about hidden gem. So, which is the stock that you will talk about today?
So budget is around the corner. Infra spend is, I think, is going to be the theme of the budget, like it has been there. So it's a kind of a very standard template this current government has been following for quite some time, and which is why I'm recommending stock from this space itself. So it's techno electric and engineering. Now this is one of the leading power infrastructure companies. So they do EPC. They are in renewable power generation, and then they do PPP projects in transmission and distribution. And overall, they are sort of entering into data centers, smart meters, and FGD market. And we expect them to become a decent, sizable player on the EPC side. And they've got a good cash balance of 1,200 crores. Last quarter, we've seen a decent order inflow of about 400 crores. And our overall sense is that we would expect once these execution starts to happen, you'll see a fairly healthy top line growth of nearly 26%, bottom line growth of 30%, and which is why and this stock is quite reasonably priced at about 13 times on FY24 basis. So our
Okay.
sense is that infra overall as a theme looks good, and within that, this is a pretty good company to sort of look at in an interesting opportunity space.
So, Pankaj, next week we have FOMC meet Fed policy. So, what do you expect from Fed this time, and what are the key events and triggers that you'll be watching out for next week?
So in the Fed policy, I think largely it's already hinted that you'll see not 75 but 50 bips kind of a rate hike. I think what is more important is the inflation trajectory which comes by because Fed is largely guided by two parameters. One, obviously, the unemployment rate, which is yet not declining. But when you sort of look at the inflation has been sort of cooling off. So if there is a decent downtick in inflation reading, then I think it's a positive for the overall market, which is what we would expect, given the fact that most of your commodities are on a downtick. And so from that perspective, post FOMC meeting, we would expect markets to sort of find direction and head
Okay.
towards 9,400 in the coming weeks. And our sense is that you'll see good participation coming from Nifty and midcaps as well. So from next week onwards, probably till next 1 month, we could expect 1,000 point kind of a rally in the markets overall.
Okay. So, optimism stays as Pankaj expects 1,000 points rally for Nifty from the current levels. Thank you, Pankaj, for sharing your views on the markets. I appreciate your time.
Thank you so much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.